Hello everyone, this is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. So today's topic is break-even analysis. So after going through this topic, the learner will be able to understand the concept of break-even analysis, determination of break-even point, simple problems of break-even analysis, managerial significance of BEA. So coming to break-even analysis, so what is the purpose of using break-even analysis? So break-even analysis is used to determine the practical applications of cost functions. So it is a function of three factors: sales volume, cost and profit. So with the help of break-even analysis, we can able to find out the relationship between sales volume, cost and profit. So it aims at classifying the dynamic relationship existing between total cost and sales volume of a company. So it is also known as cost value profit analysis. It helps to know the operating condition that exists when a company breaks even. So when sales reach at a point equal to all expenses incurred in attaining that level of sales. So in the graph, if you observe, this is the break-even point. So where the total revenue is equal to total cost. So that point is known as break-even point. So profit forecasting, planning, examining the effect of alternative business management decisions that can be done by analyzing its break-even point. So the break-even point of a firm can be expressed in two ways. It may be determined in terms of physical units. It means that what will be the volume of output, or it may be determined in terms of money value, that is value of sales. So break-even point is that where the company neither get profits nor losses. It is the static position where the total revenue is equal to total cost. So if you see this table, the output in units, then total revenue, total fixed cost, total variable cost, and total cost. So initially output in units, that is zero. So as the output is zero, there is no total revenue, but whatever amount spent on fixed assets, that remains the same 150 at all levels, and variable cost is also zero because there is no output, there is no question of variable cost. So as a result, total cost, it is the sum of total fixed cost plus variable cost. So we'll have 150. Whereas if you are going to increase 50 units, your total revenue should be 200, whereas fixed cost remains same. So variable cost is 150 and total cost it is 300. When output is 100, your total revenue is 400, fixed cost remains the same, variable cost 300, and the total cost rise to 450. When you are increased additional 50 units to the existing one, so at 150 units of output, the total revenue generated by the company, that is 600 units, total fixed cost remains the same, variable cost is 450, and here the total cost becomes 600. If you observe, the total revenue 600 and total cost 600. So this is break even point. So at this point, the company neither gets the profits nor losses, where the total revenue is equal to total cost. So that point is known as break even point. So further, if you go on in adding 50 additional units, so you see your revenue also increases. As a result, your cost of production will also goes up. What are the assumptions of break-even point? So the assumptions of break-even analysis are: first, all costs are classified into two. One is fixed cost, another one is variable cost. And second assumption is that fixed costs remain constant at all levels of output. So whatever may be the level of output at all levels, the fixed cost remains the same. Variable cost vary proportionally with the volume of output. Only variable cost changes based on the volume of output, and selling price per unit remains constant in spite of competition or change in the volume of production, and there will be no change in operating efficiency, it remains the same, and there will be no change in the general price level, that also remains the constant. Volume of production is the only factor that affect the cost. Volume of sales and volume of production are equal, hence there is no unsold stock. There is only one product, or in the case of multiple products, sales mix remains constant. Then, coming to the uses of break-even analysis, information provided by the break-even chart, it can be understood very easily. Then, those contained in the profit and loss account and the cost statement. So, whatever will be projected in the profit and loss account and cost statement, that we can see in the break-even chart itself. So, it discloses the relationship between cost, volume, and profit. It reveals how changes in profit. So, it helps in management for making effective decisions in the organization. And it is very useful for forecasting cost and profits in the long term planning and growth. The chart discloses profits at various levels of production that we can easily make out with the help of break even chart. It serves as a useful tool for cost control. So based on this break even chart, we can able to find out the weak spots where we have to reduce the cost, so that can be analyzed with the help of break-even chart. It can also be used to study the comparative plant efficiencies of the industry. And analytical break-even chart presents different elements in the cost: direct material, direct labor, fixed and variable overheads. Everything we can find out in case of analytical break-even chart. Then coming to demerits of BEP. So break-even chart presents only cost, volume, profits. So it ignores other considerations like capital amount, how much we have incurred, how much capital incurred in the business, what kind of marketing aspects you are considering to commercialize your product or service, and what will be the effect of the government policies, etc., which are necessary in decision making, that may not be possible to exhibit in the break-even chart. It assumes that sales total cost and fixed cost can be represented as straight lines. In actual practice, this may not be so. So there will be obviously a lot of changes, fluctuations in terms of sales, cost and fixed cost. So it assumes that the profit is a function of output. This is not always true. The firm may increase the profit without increasing its output. Another major drawback of BEC is its inability to handle production and sale of multiple products. So whenever we are talking about BEC, it projects only the analysis of one single product. So in case of multiple product sale, it may not be exhibited in the same chart. So it is difficult to handle selling costs such as advertisements and sales promotion in BEC. It ignores economies of scale in production. So these are the demerits with BEP. And fixed costs do not remain constant in the long. So fixed cost, whenever we are talking about fixed cost, it remains constant in the short run, but in the long run, it may vary. Semi-variable costs are completely ignored. It assumes production is equal to sale, but it is not always true because generally there may be opening stock. So that is the reason you cannot assume production is equal to sales. When production increases, variable cost per unit may not remain constant but may reduce on account of bulk buying, etc. So, the assumption of static nature of business and economic activities is a well known defect of BAC. Then, how do we determine BEP? So, the following key terms used in determination of break even point. So, selling price we can derive with the help of fixed cost, variable cost, and profit. So selling price is equal to fixed cost plus variable cost plus profit together is known as selling price. So selling price minus variable cost, which is equal to fixed cost plus profit, it is known as contribution. So contribution per unit can be derived with the formula selling price per unit minus variable cost per unit. Then we can able to derive contribution per unit. Then how to compute this contribution margin ratio? So contribution margin ratio can be derived with the help of the formula contribution margin ratio is equal to selling price minus variable cost by selling price. So contribution margin ratio is also known as P by E ratio. So BEP in units is equal to fixed cost by contribution margin per unit, where contribution margin per unit already we know how to calculate. It is the difference between selling price per unit and variable cost per unit. Then if you are going to calculate BEP in terms of value, it can be derived by the formula fixed cost divided by contribution margin ratio, where contribution margin ratio is the ratio of contribution margin per unit to selling price per unit. Then these are the formulas generally we are going to use in break-even analysis. The first one is contribution per unit, selling price per unit minus variable cost per unit, break-even point, activity level at which there is neither profit nor loss. So it can be find out with the help of the formula total fixed cost divided by contribution per unit. Then we can able to get the break-even point. Then contribution or sales or C by S ratio, which is also known as PV ratio, profit volume ratio, which is derived with the help of contribution to that of sales into 100%. Then sales revenue at break-even point calculated by fixed cost divided by PV ratio. Margin of safety in units calculated. It is the difference between budgeted sales units minus break-even sales per unit. Then margin of safety in terms of percentage, which is equal to budgeted sales minus break-even sales divided by budgeted sales into 100%. And sales volume to achieve a target profit, which is equal to fixed cost plus target profit divided by contribution per unit. So using these formulas, we can able to find out break-even point. So let us take some example. Number one, a firm starts with its business with fixed expenses of 60,000 to produce commodity X. Its variable cost is 2 rupees per unit. Prevailing market price of the product is 6 rupees. How much the firm should produce to earn a profit of 20,000 at this price? So the given data is like that fixed cost given, which is 60,000 rupees, and variable cost per unit 2 rupees per unit, selling price per unit, which is also known as prevailing market price, and it is given as 6 rupees, and desired profit is 20,000. So using this data, initially we have to find out contribution per unit, which is calculated by the formula selling price per unit minus variable cost per unit. So selling price is 6 rupees, whereas variable cost per unit is 2 rupees. So marginal cost contribution per unit is 4 rupees. This is the contribution per unit. Now we have given sales volume to achieve a target profit. So the target profit which the company has to achieve is that can be derived as fixed cost plus target profit divided by contribution per unit. So we have fixed cost. The fixed cost is 60,000 plus the desired profit that the company would like to earn 20,000 divided by 4 rupees. So if you simplify that, we'll get 20,000. So therefore the firm should produce 20,000 units to earn a profit of 20,000 rupees. So then only they can able to generate 20,000 rupees as profit if the firm should produce 20,000 units. Then you take another example. Consider the following data of a company. We have given sales, fixed cost, variable cost. Then based on this data, we have to find out contribution, profit, BEP, and margin of safety. So first one is contribution. So here per unit value is not given. So directly you can take it is the difference between sales minus variable cost. So contribution is 22,500 rupees. And next we have to calculate profit. As we know the contribution and we know fixed cost. So contribution is equal to, we can also find out contribution is equal to fixed cost plus profit. So contribution we have given how much? 22,500 is equal to fixed cost is 7,500 plus profit. If you take the difference between 22,500 minus 7,500, we'll get profit of rupees 15,000. Then next we have to calculate BEP in value. So as in the data we haven't given per unit value, that is the reason we have to consider, we have to calculate BEP in value, and the formula is fixed cost divided by profit volume ratio. So PV ratio can be calculated now, or it is also known as C by S ratio or contribution per margins ratio, S minus V by S into 100, where S stands for sales minus variable cost divided by S into 100. So your PV ratio is 56.25%. So using that, we have calculated BEP, which is equal to fixed cost divided by PV ratio, 7,500 divided by 56.25%. Then BEP in terms of rupees is 13,333.33 rupees. And next we have to find out margin of safety. So margin of safety is the difference between budgeted sales minus BEP sales. So divided by budgeted sales into 100. So budgeted sales already we have given, that is 40,000 is the estimated sales minus sales at BEP we have calculated divided by budgeted sales into 100. So the margin of safety in terms of percentage is 66.67%. So like this we have to calculate the problems using BEP analysis. And one more problem, Pepsi company produces a single article. Following cost data is given about its product. So some data related to the cost exhibited in the example. So using that data, we have to find out different types of points. First one is PV ratio. Second, break-even sales. Third one, sales to earn a profit of 2,000. And profit at sales of rupees 60,000. New break-even sales if price is reduced by 10%. So first one is PV ratio. So PV ratio we can find out with the help of contribution divided by sales into 100. So contribution is per unit value is given 40 rupees per unit, and variable cost is also given, that is 24 rupees. Then with the help of that we have calculated P by V ratio, which is 40%. Then B sales, break even sales, which is derived with the help of the formula total fixed cost divided by contribution per unit. So total fixed cost is 16,000, which is given in the problem, divided by contribution per unit, that is 16 rupees. So break even sales we have calculated 1000 rupees as break even sales. And third we have to find out sales to earn a profit of 2000 rupees. So fixed cost plus target profit divided by contribution per unit. So if the company want to generate 2000 rupees profit, then company has to produce 1125 units they have to produce so that they can earn a profit of rupees 2000. Then fourth point is that profit at sales of 60,000 rupees. So if the sales volume is 60,000, then how much profit we can able to derive. So here sales we have given, that is 60,000, which is equal to, we know fixed cost. Fixed cost is 16,000, and this target profit we don't know, and we know the contribution per unit, that is 16 rupees. So 60,000 into 16 divided by 16,000. Then here how much profit the company can able to generate means approximately 60 rupees. So this is how we used to calculate the break even sales and what will be the desired profit if the sales volume increases or decreases by 1% or 10%. So another example, assume that as an investor you are planning to enter the construction industry as a panel framework supplier. The potential number of forthcoming projects you forecasted that within 2 years your fixed cost for producing framework is 3 lakhs rupees. The variable unit cost for making one panel is 15 rupees. So the sale price for each panel will be 25 rupees. If you charge 25 rupees for each panel, how many panels you need to sell in total in order to start making money? So if you want to generate profits, then we have to find out BEP sales, and with the help of BEP, we can find out the company has to produce 30,000 panels so that they can earn 25 rupees as profit per unit. And find BEP in rupee and in units from the following information: and sales at the rate of 25 rupees per unit, variable cost 15 rupees per unit, fixed cost 30,000, and produced unit is 1200 units. So here we have to calculate BEP in terms of units, which is equal to total fixed cost divided by contribution per unit. So 30,000 already given, that is fixed cost divided by the contribution per unit, 25 minus 15. So then we can get BEP in units. Thank you.
Like, share, and subscribe. Hit the bell icon for more updates.